Welcome to our deep dive into this, I guess, sometimes intimidating world of bond markets and interest rates and all that. You've given us a ton of lectures on money and banking, so we're really going to try to sift through it all and get to those golden nuggets of knowledge.
Yeah, what I think is so interesting is that a lot of people think of the interest rate like it's this one thing.
Right.
But in reality, it's a whole ecosystem of rates that are all kind of influenced by this really complex interplay of factors.
Right.
And you can almost think of it as like a giant marketplace. But instead of fruits and vegetables, people are trading something much more abstract.
Okay.
They're trading the right to use money now rather than later.
I love that analogy. That's a good one. It really captures just how dynamic this whole market is. And, speaking of marketplaces, I noticed in the lectures, there's a lot of focus on treasury securities. Why are those so central to the conversation?
Well, Treasury securities are really like the bedrock of the bond market because they're backed by the full faith and credit of the U.S. government.
Yeah.
They're seen as these incredibly safe investments, and that makes them kind of a benchmark for all other types of bonds.
Okay.
It sets kind of a baseline for interest rates across the market.
So when the government issues these treasury securities, and we're talking about bills, notes, bonds,
Yeah,
are they basically just saying, hey, lend me some money?
exactly. And investors are more than happy to lend, knowing they'll get a fixed return over a set period of time.
Okay.
And this creates what we call the secondary market,
Yeah.
where bonds are actively traded after their initial issuance.
Okay, so like a giant flea market for bonds.
Yeah, you can think of it that way.
Okay.
Investors can buy and sell, creating liquidity, offering a wider range of maturity options.
Yeah.
You know?
Right. That actually makes the secondary market way more clear for me now because I always think of it as just like the initial transaction,
Right.
not this constant buying and selling.
Yeah, it's a flow.
Yeah. You mentioned bills, notes, and bonds. I'm guessing it's not just the name.
Yeah.
What are the key distinctions?
You're right. It's all about maturity bills are the shortest they mature in a year or less. Notes are kind of the middle ground ranging from 2 to 10 years. And then bonds are the long haul. They typically mature in 30 years.
Oh, wow. Okay.
Yeah.
So the longer you tie up your money, the longer the race, the greater the potential return.
Yeah.
But does that also mean greater risk?
Yeah, that's a really important question.
Yeah.
Generally, longer-term bonds do carry higher interest rates.
Okay.
Because as you said, there is more risk involved. When you lock in your money for a longer period, you're exposed to more potential economic ups and downs.
Right.
Inflation could erode the value of your returns.
Right.
Interest rates themselves could rise,
Yeah.
making your bond less attractive.
Yeah.
And then there's even the risk, though. It's pretty rare that the issuer could default.
You know what I found really interesting in these lectures were these specialized treasury securities, strips and tips. They seem to add a whole other layer of complexity. I don't even know where to begin with that.
Yeah, well, they provide these really unique ways to kind of tailor your investments to specific needs and, appetites for risk. So STRIP stands for Separate Trading of Registered Interest and Principal Securities.
Oh, my goodness.
Essentially, it allows investors to buy just the interest payments or just the final principal payment of a bond.
Oh, so you can slice and dice it?
Yeah, exactly.
Yeah.
You can kind of pick and choose what suits your taste.
Wow. Okay. And what about tips?
So TIPS stands for Treasury Inflation Protected Securities.
Okay.
And these are designed to protect against inflation, which of course can erode the value of your returns.
Right.
So the principal amount on these bonds actually adjusts with inflation.
Wow.
So if inflation goes up, the amount you're paid back at maturity also increases.
Interesting.
Yeah, it's a good option for investors who are seeking a predictable income stream that maintains its purchasing power over time.
If I'm being honest, I'm not planning on becoming a bond trader anytime soon.
Right.
Why should I even care about these little details? Like, how does this market actually impact my everyday life?
That's a question a lot of people probably have.
Right.
But the truth is, even if you never buy a bond directly, understanding the bond market can be surprisingly empowering.
Okay.
Because interest rates, which are largely determined in the bond market, are kind of like these hidden puppet masters behind so many of your financial decisions.
Okay.
They influence everything from mortgage rates, car loan cost, to the returns you get on your savings accounts.
So it's not just about bonds, it's about understanding how this market sets the stage for all sorts of choices we make every day.
Yeah, exactly.
All right, so what actually drives those interest rates up or down?
Well, it's not as simple as, one person pulling levers.
Right.
It's more like a very complex dance between a bunch of different players of the government, businesses, and even individuals like you and me.
Okay, so lots of moving parts.
Yeah, lots of moving parts and definitely some unexpected turns.
I'm ready to learn the steps of this financial dance. Let's do it.
Okay, let's start with the government. When they run a budget deficit, meaning they spend more than they take in through taxes,
Uh,
they have to borrow money to cover the difference.
okay.
And they do this by issuing more treasury bonds.
So it's like the government going to that marketplace we were talking about
Sure.
saying, hey, we need some cash.
Yeah.
Anybody want to lend?
And as the government issues more bonds, the supply of bonds in the market increases. Yeah. And that increased supply can actually lead to lower bond prices,
Okay.
which in turn pushes interest rates up.
Okay, so more bonds equals lower bond prices,
Right.
but higher interest rates.
It seems a little counterintuitive,
Yeah.
but remember, bond prices and interest rates have this inverse relationship.
Okay.
When bond prices go down, interest rates go up and vice versa.
Got it. Like a seesaw.
Exactly.
One goes up, the other goes down.
Right.
So the government's borrowing can really ripple out and
Mhm.
affect interest rates across the whole economy. What other factors play into this?
Well, another interesting player is the nation's current account deficit.
Okay.
This measures the difference between the value of goods and services a country imports and exports.
Okay.
When a country imports more than it exports, it basically means it's borrowing money from the rest of the world.
Wait, so buying stuff from other countries can actually impact our interest rates?
It can, and in a kind of surprising way.
Mm-hmm.
When we run a current account deficit, it actually increases the supply of funds that are available for lending within our own economy.
How does that work?
So think about it this way. When we buy goods from, let's say, China,
Mm-hmm.
we're sending them dollars, right?
Right.
Those dollars eventually flow back into our financial system,
Okay.
often in the form of investments. And this influx of foreign capital increases the supply of what we call loanable funds,
Okay.
which can actually put downward pressure on interest rates.
So our spending habits actually influence the cost of borrowing back home.
Yeah, it's all connected.
Wow. Okay, so what happens during something like a recession? How does that shake things up?
Recessions can definitely throw a wrench in the gears.
Yeah.
When the economy slows down, businesses and individuals tend to borrow less,
Okay.
which reduces the demand for loans. And that decreased demand can lead to lower interest rates. Also, central banks like the Federal Reserve in the U.S. often lower interest rates during recessions
Mm.
to try to encourage more borrowing and kind of jumpstart economic activity.
So it's like this chain reaction. The economy weakens, demand for loans drops, interest rates fall.
Mm-hmm.
How does this actually play out, though? In real life decisions? Like, give me an example.
Yeah, sure. Let's go back to our friend Jane. She's trying to decide whether to buy a car now or save up for 3 years and buy it outright.
Okay.
Prevailing interest rates play a huge role in her decision.
Right.
If interest rates are high,
Mm.
her monthly payments on a car loan are going to be higher, which makes saving seem more appealing.
Right.
But if interest rates are lower, it might make more sense to borrow and enjoy the car sooner.
So it's not just about whether to buy a bond or not. It's
Okay.
about how these interest rates affect our everyday choices.
Yeah, from mortgages to car loans, even saving for a down payment on a house,
Yeah.
it's all connected.
Okay. You mentioned before that bonds are generally considered less risky than stocks. Can you talk about that a little bit? Because honestly, the stock market has always seemed a lot more like a roller coaster to me.
Yeah.
Bonds feel a bit more predictable, but why is that?
Well, you're right. Stocks and bonds have very different risk profiles. With a bond, you're essentially lending money to a government or a corporation,
Mm-hmm.
expecting a fixed return over a set period of time.
Okay.
As long as the borrower doesn't default,
Uh-huh.
you know pretty much what you're going to get back.
So it's a fixed income investment.
Okay,
You're
chief.
buying that future stream of payments.
Precisely. Now, with stocks, on the other hand, those represent ownership in a company.
Okay.
Your return is tied to the company's performance and how the market values its shares.
So if the company does well, your investment grows.
Exactly. But if the company struggles,
Yeah.
you could lose money.
That's a big difference.
Yep, it's a trade-off. Stocks offer the potential for higher returns, but they also come with the possibility of losses. And that's why stocks are considered more volatile than bonds.
That makes sense, but it also seems pretty daunting. How do you even start to figure out how to make good investment choices?
Well, that brings us to a really important concept that comes up in a lot of these lectures. Diversification.
Yeah, I have heard of that.
You know the saying, don't put all your eggs in one basket?
Yes. My portfolio can attest to that.
I think we've all been there. Diversification is all about spreading your investments across different asset classes. So stocks, bonds, real estate, even things like commodities.
Okay.
This strategy helps to reduce your risk because if one asset class does poorly, others might do well, and that kind of cushions the overall impact on your portfolio.
So it's about balance,
Yeah.
spreading the risk, not betting everything on one horse. How do you choose what to include in your portfolio, though?
That's where things can get a little overwhelming, especially if you're not a financial expert. But there are a few key strategies that can help.
Okay.
One is understanding your own risk tolerance.
So before you even jump into the market, you
Yeah.
need to kind of take stock of how comfortable you are with risk.
Exactly. Are you someone who prioritizes preserving your capital, or are you comfortable with more ups and downs in pursuit of growth?
Okay.
Once you understand your risk appetite, you can start exploring different investment options that match your goals and comfort level.
Okay, so step one is self-awareness.
Yeah, know yourself.
What comes after that?
Then comes research. There are tons of resources available to help you research and compare different investment options.
Okay.
You can find valuable information on reputable financial websites,
Yeah.
publications, even talk to financial advisors.
Do your homework. Talk to the experts. Don't go in blind.
Exactly. And remember, there's no one right answer.
Right.
Your investment strategy should be tailored to your specific goals, your risk tolerance, and your time horizon.
Okay, so it's a personal journey,
Yeah.
not a one-size-fits-all recipe.
Mm-hmm.
All this talk about markets and investments and everything, my head's spinning a little bit.
Yeah.
How can I stay informed? How do I not get lost in the weeds?
That's a great question, and one we'll explore in more depth after a quick break.
Okay, so we've talked about a lot, the bond market, the stock market diversification. It seems like the financial world is always throwing new information at us. How do we keep up?
Yeah, that's a really important point.
Yeah.
I think staying informed doesn't mean you have to become like a Wall Street expert or watch the news all day.
Right.
It's more about creating a habit of continuous learning.
Okay, so it's a marathon, not a sprint.
Exactly.
Mhm.
So what are some of the habits that can help us stay ahead of the curve?
Yeah.
One strategy I always recommend is just setting aside a little time each week, even just 30 minutes, to read articles from some reputable financial publications. You don't have to read every single thing.
Right.
But scanning the headlines and diving into pieces that look interesting can help you stay up to date on the major trends and developments.
So like staying in shape a little bit every day goes a long way.
Exactly.
Yeah.
Are there any publications you'd recommend?
Yeah, are the ones that you like?
Absolutely. So for a broad overview of financial news publications like the Wall Street Journal, Financial Times, Bloomberg are all great resources. For more in-depth analysis and commentary, you can check out The Economist, Barron's, Forbes.
Okay, those are some good starting points. I have to admit, though, sometimes I feel like the financial world is speaking a totally different language.
Yeah.
All the acronyms and jargon.
It can definitely be overwhelming.
Yeah, even if you're trying to stay informed.
You're right.
Yeah.
But knowledge is power. The more you understand about the markets and how they work, the more confident you'll feel making your own financial decisions.
Right.
So don't be afraid to ask questions. Look up terms you don't understand. Just keep learning.
It's about taking control and not letting the jargon scare you away.
Exactly. And there are so many resources out there now to help make learning about finance more accessible. You know, podcasts, online courses, even financial literacy apps that are designed to make things easier to digest.
Wow, it's like having a personal finance tutor right in your pocket.
Yeah, exactly.
Even with all the information out there, it's hard to know what to focus on. Are there any areas that you think are especially important for like the average investor to understand?
I think aside from, the basics of stocks and bonds, understanding the concept of the yield curve is incredibly valuable.
Oh, okay.
It's a simple graph, but it can provide really interesting insights into where interest rates might be headed.
Oh, okay.
And as we talked about, the shape of that yield curve, whether it's upward sloping flat or downward sloping, can tell us something about market expectations.
Right.
About future economic growth inflation.
So it's like getting a sneak peek at the future of interest rates.
Exactly. And since we've learned that interest rates touch so many parts of our financial lives,
Right.
understanding the yield curve can help you make smarter decisions about when to lock in a mortgage, maybe when to adjust your investment strategy.
I'm starting to see how all these pieces fit together. Understanding how the market works, staying on top of trends, using tools like the yield curve.
Wow. And remember, it's not about becoming an expert overnight. It's a continuous process.
Yeah.
The financial world is always changing. So staying curious, asking questions, and always learning new things is so important.
This deep dive has been so insightful. I feel like I have a much better grasp on how bond markets and interest rates work, and even more importantly, how they affect me.
It's been great exploring these topics with you, and I hope our listener feels empowered to take control of their financial journey
Yes,
and approach the world of money with more confidence and knowledge.
absolutely. To our listener, the more you know, the more power you have. Keep learning, keep asking questions, and your financial journey is just beginning.